Last session, we talked about PE ratios, the most widely used multiple in the world, and lots of analysts still use PE ratios. But in the last 2 to 3 decades, we've seen a proliferation of other earnings multiples. In this session, I hope to look at some of those earnings multiples. In particular, I want to look at a multiple, enterprise value to EBITDA, that's widely used in acquisition valuation and in equity research. Most analysts who use it often don't know what to control for. And in this session, I hope to emphasize that the variables that drive intrinsic value, cash flows, growth, and risk are embedded in your enterprise value to EBITDA multiple. So at the end of this session, I hope you will be able to tell me what companies look cheap or expensive based on that multiple. The last session we talked about PE ratios. Classic equity earnings multiple, been around a long time, lots of investors love to use it. But in the last few years, especially in the last 20 years or so, you've seen a shift away from equity earnings multiples to what I call enterprise value multiples. Let me explain what I mean. Remember our earlier definition of enterprise value? Enterprise value is market value of equity plus debt minus cash, the value of the operating assets of the company. In an enterprise value multiple, you relate that number to some measure of enterprise earnings or enterprise cash flow. Now, the most logical measure of enterprise cash flow in an intrinsic value world is the free cash flow to the firm, which is after-tax operating income, minus net capex, minus change in working capital. I'll also tell you that you'll almost never see a multiple of true free cash flow to the firm. In fact, if you see a multiple of enterprise value to free cash flow, I can almost guarantee you that it's not been done right, that people stop somewhere in the middle. In fact, what's more common with enterprise value multiples is to see a multiple of EBIT, operating income, after-tax operating income, or most of all, EBITDA. The enterprise value to EBITDA multiple is perhaps the most widely used multiple in many sectors of equity research. So I thought it makes sense to actually focus in on that multiple because everything I say about that multiple applies to other enterprise value multiples as well. Now, with enterprise value to EBITDA, here's the basic definition that you have to deal with. You could take market value of equity plus market value of debt and divide by EBITDA, but almost nobody uses that. In fact, in practice, what you see is enterprise value is computed as market value of equity plus debt minus cash. As I said, lots of analysts use EV to EBITDA multiples. And when I run into them, I ask them a simple question. Why do you net cash out of the numerator? Why do you use net debt instead of gross debt? And you almost never get the right answer. The answers you get are because cash is liquid and I could use it to pay off what I spend to buy a company. That's not the right answer. The reason we net cash out of the numerator is because the income from cash is not part of EBITDA. It's for a consistency reason. And in fact, when I open that door, it's a Pandora's box. Because not only should I be netting out cash, I should also be netting out any other assets whose earnings are not part of EBITDA. You know what I'm talking about, right? Remember the cross-holdings discussion we had? If you have minority holdings in other companies, if you want to compute the enterprise value to EBITDA correctly for this company, you have to be netting out the market value of those cross-holdings, not just the book value. If you have a majority holding in a company, you have a different problem. Your market value of equity reflects as 60% of the subsidiary that you might own. Everything else in that equation, the EBITDA, the debt, and the cash, come from consolidated statements where you count it 100%. So what you'll often see analysts doing is adding the minority interest, the 40% that doesn't belong to the numerator. But the problem is minority interest, at least from the balance sheet, is a book value number. You have a mishmash. What I'm trying to tell you is getting consistency with EV to EBITDA is easier on paper than it is in practice. So now that we've defined EV to EBITDA, let's describe it. Before I describe it, I also have to tell you that EV to EBITDA multiples are notorious for rules of thumb. What do I mean by that? You'll see private equity investors, LBO investors tell you that any company that trades at less than 6 times EBITDA is cheap. You have to wonder, where do these numbers come from? In fact, that 6 times EBITDA is a very widely used number for a cheap company. Is 6 times EBITDA cheap? Well, it depends. In 2013, it wouldn't have been a bad measure of cheapness. About 25% of companies globally trade at less than 6 times EBITDA. 25% of 40,000 companies is still 10,000 companies, but at least it's the 25th percentile. But to show you the danger of these rules of thumb, I'm going to go back to 2009. And in 2009, 6 times EBITDA would not have been cheap. Half of all US companies, in fact, half of companies globally traded at less than 6 times EBITDA in 2009. That's not my definition of cheap. What am I asking you to do? If you have a rule of thumb, given that we have the data today, why not make it a flexible rule of thumb? What I mean by that is you have all of the data, why not make the 20th percentile or the first quartile your measure of what's cheap? The data is there. That'll allow you to adjust what's cheap from year to year based on what the market's done. And it'll give you a more reasonable way of thinking about cheap and expensive rather than using an absolute number across time. So now that we've defined and described EV to EBITDA, let's think about what drives the EV to EBITDA multiple. Remember the little technique we used to get price earnings ratios? We'll do the same thing for EV to EBITDA, but because it's an enterprise value to EBITDA multiple, I'm going to go back to an enterprise valuation model. The value of a firm is the expected free cash flow to the firm divided by the cost of capital minus growth. It's a stable growth free cash flow to the firm model. Free cash flow to the firm itself can be written as a function of EBITDA. So basically you can write out free cash flow to the firm as EBITDA times 1 minus T, so basically it's the after-tax EBITDA, plus a depreciation tax benefit, depreciation times the tax rate, minus CapEx, minus change in working capital. You're saying, why are you messing things up? Why not leave it as free cash flow to the firm? I'm going to replace the numerator in that firm value equation with the expanded version of free cash flow to the firm. And then I'm going to do my algebra. To do my algebra, I'm going to get the drivers of EV to EBITDA. For a stable growth firm, the EV to EBITDA multiple is a function of the following variables. It's a function of the tax rate. Why does tax rate matter? Because EBITDA is a pre-tax number. The higher your tax rate, the lower the enterprise value is going to be for a company. In fact, think of the limiting case. Assume your tax rate is 100%. You should be paying for this firm if all the income is going to be taxed. So the higher the tax rate, the lower the EV to EBITDA. Second factor to drive the EV to EBITDA is the expected growth rate. Other things remaining equal, the higher the growth rate, the higher the EV to EBITDA. Third factor that drives the EV to EBITDA is your cost of capital. The riskier a firm, the higher its cost of capital, the lower the EV to EBITDA multiple. Final factor that drives the EV to EBITDA is how efficiently are you delivering growth? What kind of reinvestment do you need to sustain that growth? And other things remaining equal, the higher the reinvestment rate, the more the CapEx, the more the change in working capital, the lower the EV to EBITDA multiple. We've got the variables that drive EV to EBITDA. Let's put them to use. I'm going to take a very, very simple company with a 36% tax rate. CapEx is 30% of EBITDA. Depreciation is 20% of EBITDA. It's in stable growth and has no working capital requirements. Its cost of capital is 10%. Let's plug the numbers in. This is a stable growth company. I can plug the numbers directly into that equation we saw on the previous page. And if I do, the intrinsic EV to EBITDA for this company is 8.24. You see, what do you mean intrinsic? This is what I would get if I used a discounted cash flow model to value this company. This company should trade at 8.25 times EBITDA given its characteristics. And you're saying, so what? What's interesting about this hypothetical example is I can hold everything else constant in my spreadsheet and change one variable at a time. And that's exactly what I tried. I changed just the tax rate. And guess what? As my tax rate goes from 0% to 50%, my EV to EBITDA goes from more than 16 times EBITDA to less than 7 times EBITDA. My EV to EBITDA is very much a function of my tax rate. Keep that in mind. When you're comparing Irish Telecom to Deutsche Telekom, Irish Telecom has a 12% tax rate, Deutsche Telekom has a 30% tax rate. If you're not careful, Deutsche Telekom is always going to look cheap to you just based on EV to EBITDA. It's a control for tax rates. Second, I kept everything else constant and changed the return on capital. Holding all else constant, the higher the return on capital, the higher the EV to EBITDA multiple. Companies that deliver high returns on capital should trade at much higher multiples of EBITDA. In fact, if you consolidate the return on capital and cost of capital into one measure, companies that deliver higher excess returns, earn over and above their cost of capital, should trade at much higher multiples of EBITDA. So try this out. Set up a simple company in an Excel spreadsheet. Try changing the numbers. Get a sense of how, as the variables change, the EV to EBITDA multiple changes. And here's how you should use it. Let's assume I'm trying to sell you a company based on EV to EBITDA. I call you and say, hey, this company looks cheap. Its EV to EBITDA is 6. Have your questions lined up. What's your tax rate? What kind of return on capital do you deliver? How much do you reinvest? What's your growth rate? What's your cost of capital? By the time you have the answers to all of those questions, most companies that are offered to you as cheap companies drop off the list. Again, what you're looking for is a mismatch. As with PE ratios, look for a mismatch of low EV to EBITDA with none of the variables that should cause a low EV to EBITDA. So in summary, enterprise value multiples are no different from price earnings ratios, but the variables you focus on will change subtly. Rather than look at equity variables, cost of equity, return on equity, growth in equity earnings, you're going to be focusing on firm variables, return on capital, cost of capital, growth in operating income. And while the equation we used was a stable growth model, the variables will stay the same if you have a high growth company. That's one of the great things about that very simple way of backing out the variables. So let's try one final example to kind of bring home what we just said. Okay? You have a table here, very difficult to read table because the font's really small. But it's a table of trucking companies, basically of their EV to EBITDA multiples. I want to focus on one company on that list that looks very interesting, Ryder Systems. Now, if you live in the US or you've been to the US, you know Ryder System rents out trucks for people to move themselves. It's been around a long time, and it looks really cheap. It's trading at 2.91 times EBITDA. In fact, I pulled this off an equity research report that suggested that this was the reason you should buy Ryder Systems. But here's why you should be cautious. Trucking companies invest in a strange way. They don't reinvest for years on end, then they replace their entire fleet. You know why Ryder Systems look cheap? It had the oldest fleet in this sector. So you'd have thought it was a cheap company, bought the stock at 2.91 times EBITDA, and 2 weeks later you'd have woken up to a very harsh reality, which is Ryder Systems would have to issue a lot of debt to fund the next expansion or the next replacement of its fleet. So with infrastructure companies in particular, where you see EV to EBITDA is used a lot, be very careful about both the timing of reinvestment and second, the age of the assets that you're looking at. So in summary, EV to EBITDA multiples are simple to explain if you go back to basics, and you should always go back to basics.